Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. All eyes were on China just before the Golden Week holiday, with reports indicating that the brokerages and exchanges were working overtime to cater to the anticipated reopening demand. Fund managers who were underweight on China were starting to question whether they had missed the bus as the Hong Kong markets rallied during the break. But as China's market reopened today, the reality diverged from those expectations. Good morning, Shikhar. Great to have you back. FOMO seems to be making a strong comeback in the markets, especially with all the hype around China's reopening. What's your take on the current state of the Chinese markets?
Hi, good morning, Swaraj. And yes, indeed, there was quite good a hype on the Chinese front. Chinese markets are opening after a week-long holiday, and as you mentioned, stock exchanges and brokerages were prepping themselves for a major move. But from the looks of it, markets came in with a surprise. The rally expectations were doused by the mildly bullish action around the opening, with just 2% for the CSI 300 benchmark against the 11% pre-market opening expectations. And rather, Hang Seng is down 5 to 6%, primarily on the sudden liquidity concerns that we are observing. And yes, there are funds talking about the shift in their weights and stating strategies about moving funds from slightly overvalued markets like India to China. But on the longer horizon, the valuation metrics might show a picture otherwise. There are quite a bit of attention on the nation's economic planner, and now since they released a set of stimulus packages last week, the this week's update didn't have much in this round.
Oh, wow, that's pretty interesting, especially with all the conversation around whether funds should be overweight, underweight China, and they are trying to shift weights from other markets. But of course, there is the other side of the things, which is the conflict in the Middle East, which seems to be giving investors worry about potential escalations. What's your take? Are you seeing any ripple effects?
Well, Swaraj, 7th October yesterday marked 1 year of the Middle East geopolitical concerns and the speculations around how Israel may respond to Iran's last week missile attacks and the possible escalations around the Iran's oil fields have been discounted by the market participants, and this has primarily led to the Brent oil soaring past the $80 levels. This rally is quite contrasting looking at the moves just a couple of weeks ago basis the basis the demand supply situation which were being anticipated on the low global activity. And if we are talking about the demand supply situation, we can't miss the disruption that can come in due to the Hurricane Milton around the Gulf of Mexico. They say the Hurricane Milton is among the strongest hurricanes, and as few as 15 million people are under watch. Even Chevron has evacuated few of their platforms for the safety around these particular hurricanes.
It seems it's not just the geopolitics, but also the climate that needs to be taken into consideration when you are evaluating markets. But Shikhar, with the oil prices rising, as you mentioned, and the storm around the Gulf of Mexico, just for our viewers, Gulf of Mexico is around the US. So the storm and the oil prices rising, do you think these present an upside risk to inflation, making the Fed's job trickier?
Uh, Again, yes, and it'll be much more trickier because just if we have to see it from the last few weeks' actions, yields on the US 10-year bonds have soared over 4%. A consistent rise in yields is being observed from the Fed's 50 basis or the double gulp cut on the September 18. But at the same time, last week's job number did shake up a few beliefs about the kind of economic performance US is having. Now, although the debt situation continues to put pressure on the US economy, we have other data points which the Fed might want to watch out for before they give any sort of major directions on the rate cut or the inflation front. Uh, Inflation in itself is expected before the next FOMC, along with another round of jobs update. Now, They should make some things clear on the data input front, although the data inputs have continued to stay quite volatile. So, yes, it is trickier in terms of inflation. Also, with the elections around the corner, geopolitics based demand supply disruptions, and also the festive periods, which are, generally the high spirit periods, which, also pushes the spending in the human capital.
Very interesting, Shikhar. Thanks for covering that in detail. And lastly, before we end this, any views on the upcoming RBI monetary policy?
Okay, so yes, we have the RBI MPC going on, and the India's bond bulls are really optimistic around the central bank, and they expect that the central bank will ease its hawkish monetary policy stance, potentially setting the stage for the next leg of a rally. And the inflation headline inflation number staying below the RBI's 4% target for the straight 2 months have somewhat supported these expectations for the policy change. But Swaraj, I'll tell you one thing that needs to be kept into consideration is the previous two inflation numbers, which were around the RBI's 4% target, also had the base effect into consideration. And with the oil prices soaring again beyond $80, RBI might want to watch the updates on the geopolitics and where the oil prices are, because it does have an implication on the inflation overall. And before any major shift in stance, RBI would want to take into consideration all these things. The monsoon was good, and the harvest is expected to be good, which should tame the volatile food prices a little. But the global slowing activity and other factors should definitely also be on central bankers' mind before any major shift in policy is communicated. For this MPC, no change in rates is the expectations as of now.
Thank you, Shikhar. It seems it's not just the Fed, but also RBI, which is in somewhat of a tricky position. So thanks, folks, for listening. It was truly a pleasure to record with Shikhar. Hope you all also enjoyed this conversation. Thanks for listening, and let's catch up again tomorrow with the fresh round of updates in the markets.